for the expansion, they only need 8 acres of land. So they will sell 2 acres away. So you don't be surprised in a year how come they purchase land, they also sell land. Sometimes they do. Okay? It's not ngam that the piece of land that you buy is that much that you want. Sometimes your next door neighbor or the next 2 neighbors is huge piece of land which you don't want competitor to buy. You will just buy first and then you carve out how much you need to use. The rest you don't use, you will also sell away a smaller plot. When you sell away a smaller plot, you're selling to other people, not your competitor. Because your competitor like you want a big piece of land. Okay? Sometimes people just need a space for warehouse, they will buy the smaller piece. So then you get this cash flow from investing activities. When you purchase fixed asset, you minus, right? Because you make use of money to buy fixed asset. You use cash in purchases. You receive cash when you dispose. The iPad, you see, when you purchase fixed asset, sorry, I left out the word fixed asset. When you purchase, you use cash. Okay, when you dispose, when you purchase fixed asset, you use money. Okay, you less. But when you dispose, you receive cash. And then there's dividend income. Dividend income means you collect dividend from your subsidiaries or from those investments. You receive cash. So then you will have cash flow from investing activities. So net, when it comes to this line, can you see net cash flow before financing? Yeah, they call it before financing. It's actually net cash flow after your operations, after all your investing. Okay, the third one is your financing. So at this point, your company from 530 now, 510 becomes 330. So we see how they make use of this 330, and at the end of the year, what is left? Yeah. Financing here means borrowings lah. F. When you issue shares, right, do you get money from the shareholder?
Yes.
Let's say I'm cut any, I want to put in more money into my nasi lemak shop. So instead of a small nasi lemak stall, I become a shop like Village Park, right? So when I decide to grow my business big, I inject more money. So issue shares, you receive cash, okay? Into the company books. Remember, we say entity is a different book from myself, from my own personal account. Receive cash when you issue shares. When you draw down loan, do you get cash from the bank?
Yes.
When you draw down, let's say I want to buy, right, the land next door, I draw down, I get cash from the bank, okay? So you will suddenly see, let's say my account right now is 330, right? Cash before. Then I draw down another 100,000. So you can see it will increase. Okay? But if I were to pay loans off, when every month I have a car loan, I still have other factory loans, what do? I use cash, right? When I pay interest on overdraft, although overdraft I don't pay back the principal, I pay interest. Does it use cash or not?
Yes.
Okay. Okay, just now up there I say there's dividend income, but now I have to pay dividend to my shareholders. I'm a steel manufacturer. I think I make some money. Now I have to pay my own shareholders. So I make use of money when I pay dividends, right? Remember the solvency rule? You can only pay dividends if you make profit, and you can only pay dividends if you turn your company into insolvent. Okay? Okay, you see the chat, you see whether you understand or not. When you make use, when you add your cash position, when you use cash and minus. So in this slide, at the end, there is 100,000 extra. Because from 530 they started, they make use to buy stock, pay creditors or whatever. They pay dividend, they buy fixed asset. Then after that, drawdown of loans and all that. You see, at the end, they still have 100,000. Okay? I pause here for a while, see whether you can absorb. Okay, the next slide I want to show you. So this part is still the same as the previous slide, no change. Okay, we stop at this 100K, here also 100K. It's the same, just to tell you. But what will the exam be is just debt service ratio. Debt service ratio, you look at net cash flow from operating activities. You less off, what you need to pay is your loan installment plus your interest payment. Okay? Principles of lending, we see whether they can repay or not, right? One of the principles we studied yesterday. So debt service ratio is, you look at net cash flow from operating activities, only from operating, not from investment, not from financing. So from your operations, net cash flow from operating activities, you less off your loan installments and your interest, repayment of loans and interest. Okay, so in this, can you calculate what is the figure you would use if I were to ask you this example? What is the debt service ratio? Can anyone just, you use your calculator and calculate? What is the net cash flow from operating activities here in this example? What is the net cash flow? Is it here, this one?
510,000.
Yes, thank you, Hafiz. What is the loan installment plus interest payments? Perry has done it. Thank you. Okay, just to introduce you a bit more of an exam question, they will ask you, what is the numerator? Numerator is the one sitting at the top. What is the denominator? The one sitting at the bottom. So in your case, Perry, what is the numerator?
510.
510, Denominator, 400. Okay, so just know this word. In Malay, I used to study my mathematics in Malay. It's called pengatas pembawa. 5 numerator pengatas, denominator pembawa. Is that sometimes in the exam question they use this word denominator. Okay? So cash flow, just very simple. OIF, O from operations, I investing, F is financing. That's all. Yeah, up or down. Yeah, numerator up, denominator down. So you just remember one part, D and D. Okay. Okay, next slide. Limitations of financial statement. Exam questions. Okay. Much as we said, wow, we want to analyze all the figures, blah, 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 blah. What is it that's some limitations? Okay. Remember just now, I think I highlighted before, we say there's historical statement and it's static. Okay, those figures are historical, static. And then it doesn't tell you even if you do a cash flow statement, it does not tell you the actual timing when the cash comes in, when the cash goes out. Okay, separately, internal management will ask us to do cash flow projection. But the cash flow statement that you find for external reporting, it doesn't tell you the actual timing. Okay? And historical also does not indicate future cash flow. Whether, let's say when I sell steel, so happen I've got a customer that want to rush off a certain amount of steel products before Chinese New Year. I'm a steel manufacturer, so they buy from me now for them to process in time for February. So you might see my cash flow until December will be quite good. But next year, the same big buyer would not repeat the same pattern. Okay, so the timing in next year may not be the same as this year. So this is one of the limitations. Okay, the other limitations of statement of financial position is historical cost, is static, not current market value. Okay, so what we do is we say we use fair value accounting. And we have also said that certain assets cannot be put in monetary terms, like how good is the chef. Okay, unless there is certain things intangible that we have patent for it. And then there's seasonal swings, okay? So we have finished until that. We go on a little bit more before we break for lunch, yeah? Okay, we break for lunch at 12:30, we come back at 2. In the case of need, I may run until 5:30. Is that okay with you? Or is there anyone in this group that needs to really run off at 5? Do you have other meetings? Sometimes I know people may set a meeting at 5:15 or 5:10. Okay, I just give you some advance notice. If you need, you can just text me or DM me separately. Okay?
Okay.
So, just now we say we have 4 chapters, about 200 slides, but we have finished chapter 1, chapter 2. Chapter 1 about 5% of 5 MCQ, chapter 2, 8 MCQ. This chapter 3, another 5 MCQ here. Quantitative means kena kira got figures Qualitative in chapter 4 means you're just reading the words only, okay? This one has to do with some calculation. But don't worry, because why? Out of the 5 questions here, not all are on calculation. You just have to remember some of the formulas only. Okay. In the credit proposal, there are many statements that you have looked at. Okay. We must evaluate all the data. That's why yesterday we studied verification of data. So these are a few things that we look at. What is good financial analysis, how to do financial statements and all that. Okay. So we go to the next one. A good analysis, this is also an exam topic. Sometimes they just ask you to pair up, Okay. Good analysis is when you have value-added analysis. The pairing not good is elevator. Elevator analysis here just means or down. Last year, the company increased the sales by 10%, up. 10% due to what? You never value add. People can calculate. I can use a robot, they can calculate, right? So value added is when you have talked to the customer and you find out, because they expand into certain markets, because they added a new product line. Okay? Then you have dynamic analysis. It's not just static. You use certain things all together to come up with it. Instead of just static. Because the last year they sold this much, that's it. But you say, how about next year? If 2024 is like that, 2025, how about 2026? Gold price has gone up a lot. If you got a company dealing in gold, you do expect 2025 the accounts to look very good because gold price has gone up a lot the last few months. Okay, what about 2026? Then you need to speak to economists. They will make prediction for you. Okay.
Hello.
We say historical analysis and prospective analysis is what I told you lah. Okay, you look at gold for example. And then you have integrated analysis. Integrated means you integrate what you know from the accounts, what you talk to the customer, you understand, and what you know from your general knowledge, from what you read. That's why as lenders, we need to talk to a lot of people to know what is happening in the market. We need to know what is happening in the world. It's not isolated analysis. We cannot just say, gold price is continue to go up also in 2026 because of what? Is it because of Donald Trump again or because of other reasons that comes in? Okay, so you have to integrate everything together. So just remember these few words: value added, dynamic, prospective, integrated versus what you should avoid. Elevator, static, historical, isolated. This is one of the possible exam area. Okay, we have said what is that? Elevator, go up, go down, we avoid it, right? You ask yourself, is it sustainable or not? Okay, has it because they have new product launch, they went to new geographical markets, or they got a new buyer? They're still selling the same thing, same markets, but they got a new buyer, they secure, or same buyer, more contract sum, higher contract sum. Dynamic. Okay, we should not just look at the static figure and that's it. So how to be dynamic? You read the notes to the accounts. Remember, we say notes to the accounts, there are 9 types. You discuss with your borrower and then you use your own knowledge. If you need to, you reclassify certain items in the spreadsheet. Remember just now I said rental income, dividend income, interest income. Some people may put it under operating revenue. Depending on your company. If you need to reclassify, you reclassify. Okay. Why do we reclassify? Because, you cannot control what your customer give you, but you can control what your company spreadsheet looks like. You want consistency. You want to compare it with competitors in the same industry. Okay, you cannot control what borrower gives you, but you can control how you input it. This is tell you the same thing definition, operating profit. Fixed as not only those interest income, even fixed assets, right? Some company, if they have some land, they do not generate income, they may still put as fixed asset, but this may distort the ratio. So if you distort the ratio, you in your input, in your own spreadsheet, you reclassified it out of fixed asset. You say it's investment property. Otherwise, it will distort the ratio, which we will study this later, the lunch. Then there is quoted investment. Quoted investment means quoted shares, listed shares. The word quoted here means quoted on a stock exchange. there's a lot of words, terminology that we use in the financial world. Somehow it's shortened. So if you why use the word quoted? It's actually is quoted on the stock exchange. Okay. Some people, some company may put it as current assets, some non-current assets, depending on your management intention, whether they want to sell or not. That's your customer. But as lenders, we consistently treat quoted investment as current assets because it can be disposed and sell liquid nature. Okay? So this is for consistency basis. Then you see what has been captured into the balance sheet, what is off balance sheet. This one we have studied just now, off balance sheet events, okay? If you know they have a major litigation outstanding, although they provide 50%, sometimes in your credit proposal you may say out of 100,000, they provide 50,000, but you think that they may lose, so you tell your management, even if they lose and they have to put in another 50 more thousand, the borrower can still pay, still enough cash flow, blah, blah, blah. Okay? So this is how you take note of it. Then you want to see shareholders' financial commitment, whether the shareholders, they have offered their own assets or not as collateral. Okay, these are the off-balance sheet items. You don't just look at history, you look at the perspective, yeah, going forward. What is the business like? Is it profitable? What is the gearing? Do they need to borrow more? And what is the cash flow? Do you think one of their large contract, they can collect all the money or they are slow in payment? Do you think certain countries that they sell to will be somehow engaged in wars and all that? I have got one real life company, they buy grains from Ukraine. Ukraine produced a lot of grains. Everything was good. Even when the conflict started, they still can collect money. But after the conflict went on for some time, after 6 months and coming close to the 12 months, that's when they find that cash flow slow down. So for the first 6 months, when they can collect, they tell us bankers, hey, we can collect, no problem, no change in my cash flow projection. But after the conflict drawn on, then they come to us and tell us, and then we readjust their cash flow projection. Okay, so this is part of the good analysis. So you look at this, we have talked about it. Okay, exam question. See the word mosaic theory here? Okay, see the word isolate and integrated. This is how they trick us. In the exam, they say, what is part of a good analysis? Number 1, integrated theory. Number 2, non-isolated theory. Number 3, mosaic theory, or ABC lah. Okay, so this is a textbook exam. Okay, we cannot use our own terminology. Textbook say the word theory is for mosaic. So when you see mosaic, it's mosaic theory. There is no integrated theory. Okay, neither is there mosaic analysis. So you just remember this word called mosaic theory. These two words must go together. Why? Mosaic is this, like the jubin, the small little tiles. If I give you some blue tiles, some white and green, you can't see the picture. You can only see the picture like a little snail or a shell when you look at all the mosaics put together. So this is what it means by mosaic theory. We cannot see what is it on its own. We have to put the jigsaw puzzle together, then we can see, oh, it's like this. Okay, it tells us a picture. Otherwise, each one of it is just one part of a jigsaw. So, and it's no jigsaw theory, it's called mosaic theory. In the exam, can you just highlight this? They will give you A, B, C, D. So look for this word, mosaic theory. Okay, so some examples you can read yourself. Debtors turnover ratio lengthen. Why? Okay, why it goes up, why it goes down. Can they pay, cannot pay? Big debtor owe them more money, or big debtor suddenly pay faster. Okay, public information, private information, what is material, what is non-material. Okay, what do accountants put inside their accounts? Okay, let me just check the time. Okay, we still got some time, we go on, yeah? Okay, prerequisites to financial statement analysis. Financial statement analysis looking at figures. The most important is you must know their borrower's business. You must have some general knowledge of each industry that your borrower is in. What does it look like? So develop some general expectations. If I tell you I'm in the supermarket industry, but my statements are when you compare with competitor, I got debtors 30 days debtors. Does it make sense? Let's say you have a KK Mart, you have Village Grocer, you have Jaya Grocer, and then another new company come to you in the same line supermarket, not as big as Village Grocer, not as big as the others, but they are still doing the same thing. So the general expectation in supermarket, you sell in cash, right? Or you use credit card, you can collect within 2 days. You don't expect to see a high debtors amount, you don't see high debtors days over there, okay? You must have some general ideas what it should look like. And then you know supermarket, what stocks do they have? What capital investment cycle? Do they like a steel plant or a plastic manufacturing plant? No, they don't have that, okay? If the numbers do not tally with what they tell you, then it's a warning sign. Okay? If the supermarket boss they collect a lot of cash, then they take the cash to buy gold bars, they just say, we decide to invest a bit lah. Is that a warning sign?
Yeah.
William, what do you think, William? William, are you there?
Hi, William.
Yeah. Can you on? I'd just like to see.
Yes.
Can you speak louder? Sorry.
Can you hear me?
I can't.
Hello.
Yeah, now slightly better. You come closer to the mic, yeah?
Okay.
Okay, so you have a supermarket prospective borrower come to you. You see they have cash, but suddenly their trade debtors look high. And then when you talk to them, they say that, actually, now I've gone into another cash business also. I'm starting to buy gold bars and sell gold bars. I'm starting to buy crypto and sell crypto. It's also cash, turn around very fast one. My operating cycle very fast. Overnight also can buy and sell. What does it tell you?
It's a warning sign because it's not related business. It's totally different industry.
Yeah. So when they want to borrow money from you and say we want to expand, blah, blah, blah. Remember the lending principle of control, yeah? So you better structure your lending correctly if you are going to lend to them. Okay. They will come and tell you, grandmother, grandfather story, I want to open 5 more outlets. I need to have capex. I need to pay a bit to new supplier, the local supplier, blah, blah, blah. But sometimes it's true, they want to expand 5 outlets, they want to borrow money, but they borrow more than they should do, and you don't have principle of control, conditions of drawdown, you find your money goes somewhere else. If
Yes.
you give them a lot of overdraft, you give them revolving credit. Okay?
Yes, understand.
So now you can see why this CCR credit is good if you can tie up things together. Okay? Okay, thank you.
Thank you.
Okay, so that first part is understand borrower's business. Okay, then there's an operating cycle. Here they want to tell you trading company is different from manufacturing companies. Okay, now trading basically you buy goods for resale, you sell finished goods, collection. Very simple. The cycle should be faster. Okay, even if they're not in supermarket, they buy and sell steel products. It's different from the steel product trader from a steel product manufacturer. Okay? It's manufacturing, they buy raw materials, they process, value-added goods, finished goods, then only they sell, then only they collect. So it's a longer cycle. And whatever prospective customer you have, get to know the general, I would say general key indicators of that industry, okay? Capital investment. Of course, if you have a manufacturing plant, you expect to see these tractors, or you will have a, say, construction company, you expect to see a lot of construction equipment. But if I have a trading company that trades in small things, you don't expect to see this. Some trading company may have a few of the tractors to move their goods around. I have got like trading agencies, Dietler, all this, their warehouse is very big, so they have some machinery to move goods around, okay? But it's different from a plant, yeah? The machinery, the capital investment cycle is different. Okay, exam question here, they will ask you, why do we need to know what capital investment cycle? Because they'll tell you what assets that you should be financing or what they need. You should know what is the cost of the machinery, new machinery versus a used machinery second-hand. And number 3 is you should know the economic lifespan so that you can structure your loan tenor accordingly. Okay, if I tell you I want to buy this machinery can use for 15 years, I want a 15-year term loan, do you give?
No.
No, because you don't expect repayment at the last year already. So maybe you give a 10-year, depending on your bank's policy, yeah? Okay, or if my machinery is 10 years, maybe you just give a 5-year term loan. Okay, so you need to know the economic lifespan, yeah? Okay, now is the balance sheet again. The word balance sheet, yeah? We look at this, why? Because it will tell you a few things. It will tell you the operating cycle versus the capital investment cycle. And then after that, it will tell you the how to finance all this. Do we finance by equity? Do we finance by bank borrowings, long-term, short-term? Okay? Then how much reserves over the years if they have made lah? Okay. If it's a new company, they don't have reserves yet. Okay, they only have equity, they intend to borrow from you. And then you will tell you, oh, I want to buy this kind of fixed asset. So you will study it. Okay? And then if it's like a steel manufacturer, you give them some trade lines because they need to import iron ore and all that. So after you understand all the nature of business, current asset, fixed asset, you need to know how the funding should be structured. Remember the ratio, 1:1, okay? So that is why we call the balance sheet as a window into the business. Okay, this will give you a good eye view of what business they are doing and how they are funding it. Let me just check a bit, yeah. Okay. Financing needs, very simple, Long-term financing, you give for long-term asset. Short-term financing for short-term asset. You do not cross it because it will be a mismatch. What you have learned yesterday looks like is theoretical, but in real life it's true. If someone comes to you and say, hey, I want to build a factory, but I want only short-term financing. Is that good?
No.
Not really, you know,
Funding needs
because
to
later
No.
you will see, what kind of banking products and what are the risks to the bankers, okay? Now, if they finance short term, they will say, don't, since I have a property, but you give me RC lah, I will repay you, or you give me OD, as and when I got money, I can pay down one. But since you give me short term, I don't want to give you a property charge. No good lah. Long term, you want, okay, charge over the long term asset, okay? Then If it's for working capital, net working capital, that means the stocks, you want to see the drawdown, you want to see the invoices, the shipping documents that come in. The operating cycle, you know, is only 6 months. You do not want to give them long-term financing. Okay, you give them working capital, trade facility that suits their operating cycle. So if it's short-term, then you give them short-term financing. Okay, so you can see there are many types. Not just OD, not just revolving credit. You get bankers' acceptances as well. Some banks, they do offer factoring, buy over the debtors' invoices. Okay. Ratio analysis. This is the beginning of the ratios that after lunch we'll look at it. But basically, ratio analysis is to tell you, it's very simple. You divide the top dollar with dollar. Okay, or you want to compare percentage with percentage, or you look at days, debtor days, turnover of stocks days. This is just to tell you there's a comparison between the borrower this year and last year and the future years, how they are doing. It can only give you also a comparison of your borrower with other players in the same industry. So these viewpoints are very important for you to form an opinion. Okay? There are 5 ratios here: solvency, debt service, all that. We will look at it. And each one of these, there's some formula. Okay, you don't need to know all. I will point out to you which are the exam topics. Okay. The first one is this, but I think we'll stop here for lunch. Is 1:55 okay with you? Instead of 2 o'clock, 1:55 okay or not?
Okay. Can, ma'am.
Okay, you all prefer 2? Okay, then
yes.
2 o'clock, okay. Then I see you at 2 o'clock. So those who can come back early, please just have a quick look through of what we have done this morning and what we are going to do in the afternoon. Okay, have a quick look through. Thank you very much. See you guys. Have a good lunch.
Thank you.
Thank you.